back to Indianomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj, Gambhir and Samiran Chakrabarty speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
It boils down to how you were looking at credit growth, whether you were looking at it from the demand side or you were looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Saugata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12-13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity? Every day, bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI. Would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samiran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12-13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4-5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember, between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth. We'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. there will be some impetus to bring the credit growth back towards 12-13% numbers by the end of this year.
Okay. A two-part question for you, Samiran. Actually, I'll put it in two separate questions. One, this 12-13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, I mean, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here.
Okay.
We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit.
Fair.
As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually in negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samiran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1 if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August, and October, and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range bound mode, around 6.25 to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink, or the RBI may advise it to bring it down. Then there is a bit of a rally perhaps at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.